Good afternoon, everyone. Welcome to Solving the Condo Conundrum, New Regulations, Rising Costs, and Aging Structures. My name is Jolene Lozada. I am a director at First Service Residential, and together with my colleague, Paul Schwartz, we will be moderating today's webinar. Hey, Paul.
Hey, thank you. Hello, everyone. Good afternoon. Thank you for being here. Over the past few years, condo boards have been hit pretty much with a perfect storm of issues. You're experiencing spiking insurance costs, higher interest rates, skyrocketing prices for labor and materials, and that's just really to name a few. But perhaps the most significant driver of change was the 2021 Surfside tragedy.
And in response, the Florida legislature has introduced regulations to enhance building safety, requiring new reserve funding for critical infrastructure and a statewide inspection plan that builds on the existing 40-year inspection process in Miami-Dade and Broward counties.
So while this is essential, obviously, for protecting lives and preserving property values, these new rules do come with an overwhelming compliance cost, leaving associations to cover unbudgeted, expensive inspections and repairs. And for some, the financial burden has become so heavy that they are considering a last resort option, which is condo termination. It's a complex issue, and there's really no easy answers. We'll be discussing strategies to address these challenges throughout today's session.
Just a few housekeeping items before we introduce our amazing panel and get into the discussion. If you have any questions throughout the webinar, please submit them through the Q&A option on your control panel. If we do not have the opportunity to address all of your questions, we will be sure to have someone from our local team follow up with you. And there's no need to take notes. We will be recording this session and sending it to all attendees. In addition, we'll be posting 2 articles on some of the topics discussed today. You may want to bookmark them for future reference. Today's conversation represents perspectives from our panel of experts. This should not be relied upon as legal advice specific to your association. As always, consult your association attorney to determine the best course of action for your association.
All right, let's get started. So I'd like to introduce our amazing panelists. As Jolene said, they're going to walk us through these issues in more detail and provide actionable advice for condo associations. So joining us first is Donna DiMaggio Berger, Esquire. She's a shareholder at Becker Community Association Lawyers, board certified specialist in condominium and plan development law, and a fellow at the College of Community Association Lawyers.
Good afternoon, everyone. Happy to be here.
Thank you, Donna. We have Sean Estevez. He's a regional director with First Service Residential.
Good afternoon, everyone. Pleasure to be here.
Hey, Sean. And Pamela Malfavan, who is our Director of Financial Products and Services with First Service Financial.
Good afternoon, everybody. Thank you for having us today.
Hey, Pam.
All right, so let's get started with the basics. Donna, can you explain the difference between milestone inspections and SIRS, which is a key concern for every condo board member right now?
Yeah, absolutely. So it's good to start off with the basics, and a milestone inspection is not the same thing as SIRS, although there is collaboration between the two. So we're seeing, Joey, a lot of people use the terms interchangeably, and they'll just reference their SIRS. I rarely hear somebody talk about the milestone inspection. The milestone inspection, it's a structural inspection of the building. It must be conducted by a licensed architect or an engineer. The deadline is the end of this year, December 31st, 2024, for buildings that are 30 years old or older, and it may apply to even younger buildings if the local authority deems it applicable. It's 3 stories or higher. 3 stories is defined by the Florida Building Code, and there are unit requirements. I'm not going to get into all of that. The big change when it comes to milestone inspections is that those inspections are now delivered directly by your engineer to the local building official. In Miami-Dade and Broward, which were the 2 counties out of 67 Florida counties that had older building certification requirements, those certification reports used to be sent directly to the board, and then sometimes boards would do not much with it, right? Now the milestones have to be sent directly to the local building official. There are 2 phases to a milestone inspection. The first phase is visual. If everything looks good, it basically ends there. The association gets the report, and then they have 45 days to send out a summary, to post it in the community, to post it on their website if they're required to have a website. If in phase one, the engineer or architect detects any sort of structural weakness or deficiency, they go on to phase two. Repairs have to be commenced within 365 days after the local authority gets that milestone inspection, but the local authority could also accelerate that timeline. So let's move on to SIRS. What's SIRS? SIRS is your Structural Integrity Reserve Study. Now, condominiums have been required in the state of Florida to have statutory reserves for years and years. This is something new. These are new components. We call them subsection G. They pertain to roof, plumbing, electrical, life safety systems. It can be the concrete structure. Same deadline, 12/31/24, end of this year. Same threshold, 3-story building as defined by the Florida Building Code. And the other huge issue that I know we're talking about today is, unlike the non-SIRS reserves, starting in budgets adopted after 12/31/24, the membership will no longer be able to vote to waive or only partially fund those structural reserves.
Right. So Donna, I have a question for you because the SIRS items, right? There's a list that the state provides that are those new mandatory SIRS items that have to be funded for going forward. Those items were already included in your traditional reserve studies that we've historically been used to getting, right? So the items aren't new. It's just now it's mandatory to fund them on a regular basis going forward. So, that impact of the mandatory SIRS funding, what we're seeing now is it can vary widely between communities, right? So it depends on what I've seen recently. Number one is the timing of the life cycle of that component. Because if you've just completed a major concrete restoration project recently, the impact of the SIRS most likely isn't going to be as bad as if it's due in the next couple of years and you haven't historically fully funded those reserves, right? And updated your previous reserve studies on a regular basis and kept up with the funding plan each year. So, you're going to see a wild swing from community to community that's really hard to compare between each other. So I was wondering if you have experienced that as well, and maybe you have some comments on that.
Yeah, I mean, no, they're great points. So we're, part of what we're trying to address here today is all the what I call the media scare, right? We've been reading all the media reports and it's so awful. For a lot of communities like the ones you're mentioning, Sean, it may not be as big of a shock because they have fully funded reserves and there's a lot of overlap between the reserves they've been funding for years and these new structural integrity reserves. However, it's not a complete overlap. For a lot of communities, there are things that they did not reserve for, like windows and doors, if the association maintains them, electrical and plumbing they may not have, because previously it was roof, painting, paving, and any other item for which the deferred maintenance or replacement cost exceeded $10,000. So yeah, I think you're absolutely right. And I'll know we'll talk about it later, that if you have been routinely, engaging, undertaking repair and maintenance project along the way, you've got a long runway ahead of you on a lot of these components. So the useful life of your roof may be 20 years out. Same thing with the painting. And as a result, when your reserve specialist produces that SIRS, the financial hit may not be as great.
Yeah, associations with a healthy reserve balance and a history of fully funding annually typically find themselves in a much better position. On the milestone inspections, right? So you talked a little bit about deadlines. So the older properties have much more aggressive deadlines that they have to meet by the end of this year, right? But those that haven't quite reached that age but are going to be there in the next few years, you really need to be mindful of those deadlines, right? And there are time limits on the milestone inspection reports that I've seen, from some of the local jurisdictions. For example, I know City of Miami Beach, they may accept a milestone inspection report within 2 years of that milestone inspection date of when it's, your deadline is. So check with your jurisdictions because it may change from year to year and from location to location. But the point of that comment is to get the process started early, but not too early, because you don't want to have yourself with an expired report that you have to do all over again, closer to your deadline. And the history of your major preventive maintenance projects and work done on the building and the deferred maintenance over the course of the years are obviously going to have a major impact on that. So be aware of those dates, start planning early, because as we know, these major projects, they take time before you even begin to do any work on the property.
Let me just add really quickly, also for our new communities that are transitioning from developer control, make sure you get the inspection reports and the SIRS from your developer, okay? It's going to be very important to start out with a clean bill of health.
Okay. I'd also add that moving forward, you may want to establish a frequency of updating your reserve studies, your SIRS and your general reserve studies on a regular basis, especially after you've undertaken a major project or have had significant expenditures in any given year. You want to make sure that you're recalibrating that annual contribution funding number and at the same time keeping up with current costs. You don't want to fall behind.
That's a great point because the law requires SIRS now to be undertaken every decade, every 10 years, but you don't want to wait 10 years. If you have just done a concrete restoration project or the roof or painting, you're going to want to get an update to that reserve study.
Yeah, good point. All right, so everyone now will say has their reports. They know what their costs are going to be. So let's turn to financing and how to potentially pay for the work in those reports. So what financing options are available for necessary repairs and upgrades in older high rises, especially given that many condo associations did not anticipate these costs? Pam, do you want to start us off?
Sure. Yeah, that's such a great question, Paul, because of course that's the biggest concern, right? How are we going to pay for these projects? How are we going to fund them? So the first thing we recommend is always looking at that reserve balance. Of course, many associations might have already been fully funded, and that's a great start, as it was mentioned before, because some of those funds could be used for these coming projects that are coming up. So looking at the reserves first, and then determining, do we have enough to cover the cost of the projects? Most likely the answer will be no. So then what is the next best option? At that time, the association, the board also could decide to just pass a straight special assessment and determine, if that's a viable option. Now, the special assessment, of course, has to be aligned with the timing of the projects, right? We cannot have the projects be completed in, anywhere between 1 to 3 years and have a special assessment that would be longer than that, right? So if it's a straight special assessment, it has to be done prior to the completion of those projects in order to be able to fund all of them. If that's not a reasonable option or doable option because of the cost of the project is so large, right? For some condos, we're talking about millions and millions of dollars. So we may need to extend that out and finance the projects. So, and also, just like I mentioned before, we could look at using some of the reserves that could be used also in this scenario. Now, the difference is that the association would be obtaining a loan to finance the difference, right? Between what they already have versus the difference that would be needed in order to complete the projects. So the interest rates right now are dropping, which is a good thing. We've already seen 2 rate drops from the Fed, and they anticipate another one this year and more next year. So this is definitely a good time to start exploring those options. And now with that, I'm going to turn it over to Donna, because I know there's ways also when we finance these projects, how do we pass the special assessment, right? And there's a way also to be added to the operating budget or pass a special assessment in order to pay back these loans. So Donna, I will pass it on to you.
So special assessment, Pam, this is what I would say. First of all, you need to look at your governing documents and make sure that you are following the protocols and provisions under those governing documents in terms of setting up the special assessment, giving proper notice, work with counsel and your management team. Because again, the whole purpose of passing a special assessment is to actually be able to collect the money, correct? But one of the things you're going to want to do is, especially if you do a multi-year assessment, I'm sure at First Service you're seeing a lot of associations that they really want to, they've got people who are struggling financially, and they want to make it as easy and comfortable for those folks to be able to meet these obligations. So they may spread out that direct special assessment that Pam mentioned over maybe 12, 18, 24 months or more. In that event, if there are units that are foreclosed, typically by lenders, in the interim, you want to make sure that you're not shutting off your ability to go after those lenders for all the subsequent installments after the lender takes title. And that's a due on sale clause. Talk to your attorney about how to set that up, because you want to make sure, again, that you're collecting from other people when they sell, so you get that infusion of cash, but you're not cutting off your nose to spite your face. You're not preventing yourself from going after lenders for the balance.
Yeah, I'd also like to chime in here because I think communicating with your membership along the way, especially, you know, the earlier the better, and frequently is going to put yourselves in a much better position to be successful in obtaining the votes that you may need to get, the financing and all of these things. You know, you really want to start that process early. Be very transparent with communicating, you know, between the board and the residents. You know, you don't want them to be surprised, right? Is the point. And then all of a sudden you're shocking them with this, you know, pressure of voting for something that they're not fully informed of, or they may disagree with because they're not, you know, they haven't been a part of the process along the way, right? So I think it's important to, you know, paint that picture very clearly with photos, reporting, hold town hall meetings, really tell the story. It also helps the board and management control the narrative of the facts and the need for the community. It'll reduce the rumors that we know start flying whenever you know these big dollars start getting thrown around, and all that speculation. You want to get the buy-in from the membership, right? Make them a part of the process, bring them along with you along the way. You know, really keep them engaged, and in addition, engage your professional partners. Like Donna mentioned, you have to involve your association attorney before you get any ideas. You have to have the conversations about process to make sure that you don't run into any trouble procedurally, or legally trying to do something or communicating an idea or a plan to the community that you find out later on you're not able to do because your docs don't allow you or the law doesn't allow you, right? So, you know, communication is super important with your membership, and even your CPA, you can involve them as well. You know, you don't have to go out alone, you know, bearing the burden of bearing the bad news, right? Engage your professional partners, your management team, your CPAs, your attorneys, and all these, you know, independent outside resources as a part of your team to help deliver the message and answer questions that your members are going to have.
John, I love what you said.
Oh,
I'm sorry. I love what you just said, because as a board member myself, we're going through that, you know, the word of mouth. What is it? The telephone line, when it starts with one person, it keeps going down, 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 down. So to your point, I think transparency is key. Over communication is key, and keeping everybody, all of the stakeholders involved throughout the process. And again, engaging the experts, right? Because the experts are going to protect us as board members from the high liability positions that we're in. So I love what you just said.
If I could just build on that, yeah, you know, the communication is key, but also communicating with your local public policy makers, local government, state representatives, state senators. I've been at a lot of meetings recently where they have called in their local representatives so they can deliver the bad news, right? Because we've got a lot of board members listening right now, and they're the ones that are, you know, on the front lines, but they're not the ones who made the law. So invite in your local rep, invite in the local, your senator, invite in your local government officials, and have them hear firsthand what these struggles are in each of these communities. It really does help. And it helps for next session, because to Pam's point about how we're going to pay for it, Pam, one of the things is there's one association in the entire state of Florida that has the option to use a line of credit as an alternate funding source for reserves, as opposed to having to increase their budget. That association had a great lobbyist who stuck it in the law, and it's one association that operates 25 sub-associations. That option should be extended to all the condos in Florida that are facing SERS, mandatory SERS funding. So I think your point is great, both of you, but I think we can expand it beyond just communication to the membership. I think we need to educate our legislature too.
Absolutely.
Great point,
And
Donna.
point in
Great
this
point.
is also the requirement for membership votes. And I'll let you, Donna, address that, but I know that's also very important because there's some governing documents that do require that, but
Oh,
please
you
go
mean
ahead.
for the, yeah, you're right, Pam. So there are
And then
documents
financing.
that really do tie the hands of the board, that they can't get a loan without membership approval, and they can't get past a special assessment beyond a certain amount without membership approval. So our public policy makers need to understand that some of these requirements are going to be virtually impossible for some communities if they have certain language in their documents. It's a great point, Pam.
And to Pam's point on the financing and the cost of, she mentioned they could be multi-million-dollar projects, right, that we're faced with. A question I see a lot of times is, well, don't we have reserves for that, right? But what a lot of people don't know, including many board members, is that reserves only account for the hard cost of that item at that moment in time, and they take an industry, average for, it could be locally, it could be regionally, or it could be for the whole state of Florida for that cost. However, different reserve analysts use different methodologies, but what they don't tell you is that it doesn't cover any of the soft costs for hiring your architects, engineers, consultants, project management, and contingencies, additional staffing that you may have to bring on board. None of that is included in your reserve funding plan. So typically these projects, the cost of these projects are way more than what you're ever going to have in reserves. So keep that in
Yeah,
mind.
and let's not even get into change orders.
Right.
All right, let's go on to the next topic. So a lot of boards are struggling with the need to increase their operating budgets. Some experts argue that the recent rise in special assessment is simply playing catch up from years of low association fees. Is it possible, in your opinion, for associations to strike a balance between keeping fees reasonable and adequately funding reserves for the future? Donna.
Let's start out by saying, Joey, that not every condo is in crisis. As Pam and Sean and I have all said, there are some condos that are really well situated right now to navigate these challenges. But for others, where they've deferred maintenance for years, where they have not funded reserves, and again, we need to understand this is normally membership driven, not board driven. There's somehow a disconnect in Tallahassee that it's boards that are doing all of this. It's the members who had the right to vote to waive reserves over the decades. So for those communities that are playing catch up in terms of the deferred maintenance and the lack of reserve funding, there's no cushion there. I don't know if they're going to be able to strike a balance. Is anyone coming to help? Is the government coming to help? I don't know. Isn't there an old joke about the government coming to help is not really much help?
Mhm.
I don't know. I mean, we could look to Miami Beach that passed an ordinance. They had a fund created. I think it was $30 million, guys, and it was gone in like 3 weeks to help people, condo owners struggling with assessments. I know there's a groundswell of voices out there saying that local governments should be coming up with some of these options. But I will say this, can you balance it? For some people, I do fear that they will probably have to make other housing choices, because they're just not going to be able to meet the increased challenges. Now, there's also this question of, do we need to catch up? You have to take a really hard look at those reserve studies, because some of the reserve studies, they're not all created equal. Sean, you touched on this. Some of them may be incorrect and saying you need to catch up this much. And some of them may not have taken into account that there was a recent repair or renovation project that's not shown on that reserve study. So you really need to think about that. I do know some people are also doing peer reviews. Are you guys seeing that, Pam? Are you seeing peer reviews on structural integrity reserve studies where they maybe feel like there's something a little amiss with the first one they got?
I think we're starting to see that because there's questions about it, right? Especially if projects have already been completed not too long ago. Well, why is it that that's already on our reserve study again? So yes, I think that's a great point to making sure everything is updated. So everything is accurate in those reports.
Yeah, and I'm seeing also not so much with peer reviews because the cost of these studies can be, $10,000 to $20,000, and just it's not economically feasible to do it multiple times within a year for most properties. But there is always an opportunity to review the drafts and really scrutinize and challenge your useful life ranges to try and get a little more time, your remaining useful life to try and get a little more time, especially if you've done really good preventive maintenance on your property along the way. Those are definitely areas that can be negotiated with your reserve analysts or engineers who are preparing those reports. Make sure that the items that are being included are accurate. Are they the association's responsibility or somebody else's responsibility, right? We've found that there are big items that we can just delete entirely because they don't belong there. But the engineer or reserve analyst, for whatever reason, initially thought that they would be. So really scrutinize them, challenge them, and you'd be surprised that you can get that funding level down a bit if you try. And that's at the end of the day, you just want to make sure that you're not being penny wise and pound foolish, right? Because you're either going to pay now or you're going to pay more later. And this is something we see every single year with these properties, right? So for many, it's time to pay the piper, and it's a big hit. And for those communities who waived funding of reserves for many years, that's not necessarily fair to the new owners who have to pay for the sins of the past, right? And have to shoulder that burden. So I think moving forward, we need to reset the conversation and the culture within the community to be good fiduciaries moving forward when it comes to proper budgeting and funding for reserves.
Yeah.
And just to be clear, for those who don't know, could you explain what peer review is?
So a peer review, and we see this across the board, it could be on an appraisal. It's a second opinion, basically. But what you're looking for typically, and I counsel associations, you're looking for a more robust review. In other words, you're not looking for another review that's going to, instead of looking at 100 balconies, they're going to look at 2. This is not just, again, we got into this mess because some communities were looking to commoditize everything, okay, and the cheaper the better. I mean, I've been at meetings where somebody who this is their second home, their vacation home, said, I could go up there and for $12,000 I could fix this, only to find out that the insurance claim, and I know, Pamela, this is your area of expertise, was like a 1.5 million in repairs. But Fred said he could go up with a hammer and fix it for 12,000. So when we're talking about peer reviews, we're not talking about just looking for somebody to tell you it's the cheapest way to do it. We're talking about life safety across the board. And again, the goal of this, the last 3 years of legislation since the tragedy at Champlain Towers is hopefully to give the state of Florida the safest housing stock in the country. That's a good thing. That will actually, even though right now we're hearing that the real estate market is a little depressed, but I think ultimately we're going to come out the end, the other side, and people are going to be flocking to the safe housing stock in Florida.
Yeah.
How do you guys feel about that?
Yeah, I mean, certainly it's going to have an advantage and the reassurance and peace of mind for buyers to know that the buildings are being properly maintained when they should be maintained, and the work is being done correctly. And, at the end of the day, like you said, I don't see how that hurts the market, right? It can only help it.
Yeah. Okay, we drew straws on this next topic, and apparently I drew the short straw. We're going to switch to insurance. So given the ongoing challenges in securing property insurance in Florida, especially with the skyrocketing costs and premiums and all the carriers that are leaving the market, how can associations mitigate the impact on their budgets? Pam?
Sure. So the first thing is understanding how we got to this point in terms of insurance, right? And we had been in a very soft market. Soft market means basically the rates were dropping, were so many carriers in the mix, there was a lot of competition, and that drove premiums down. Now, after 2017, when we were hit with Irma, we didn't see the effects immediately. But I would say in 2019, we're starting to see a shift in the market. And then in the past 2.5 years, we saw a drastic change in the market where we were seeing anywhere between 50 to 400% increases in some instances, right? For some associations. It was crazy. We saw many carriers completely leave the market. Some went insolvent. Part of the reason why this happened is because of the litigation in Florida. I mean, we are the most litigious state, right? So a lot of the carriers basically just were not comfortable here. Now, the next thing was Surfside. Unfortunately, it took a tragedy such as that one for more carriers to be even more uncomfortable, really, with insuring property for wind coverage. That's our biggest exposure here. And they also decided to either leave the market or, well, three things happened. Either they left the market, they tightened their underwriting requirements, or they decided to insure buildings for a lower amount. That was something that we never saw before. And so that meant that in the past, there really were three ways of insuring a property. You could have a standalone carrier with an admitted company such as QBE or Philadelphia, where it's great. You have one company, they take off the entire building, they insure the entire building for all the perils. That's the best case scenario. Now, we started seeing that some properties didn't fit that box, right, for those guidelines. And then we had the non-admitted, or what's also called surplus lines or layered programs. And those were very competitive for many years. Again, in the past 2 years, the premiums for those, because they're not regulated. Admitted means that the forms, the rates, everything is regulated by the state. Non-admitted means they're not regulated. They also don't participate in FICA, which is a Florida Insurance Guarantee Association that provides up to $200,000 per unit in the event of a loss and the company going insolvent. So in that case, with the non-admitted carriers, we were seeing those premium increases were just extremely high. They were astronomical. On top of that, we started to see a shift also in the valuation because, again, after Surfside, the carriers realized that many of the buildings were underinsured, they were undervalued. So they looked at those appraisals to see what is the actual cost per square footage, right? And they determined that there was no way to rebuild the buildings with the numbers they had on those older appraisals. Again, in the past, it wasn't so strict. So even if there was an appraisal that was, 5 years old, I saw some that were 7 years old, and the carriers would accept it, but that stopped, I would say, in about 2 years ago. And so now, even if there is a current appraisal or one that was done within the last 36 months, which is what the statute requires, there could be carriers that are still not okay with those cost per square footage numbers that are on those appraisals. And Donna, that's a great point that you were talking about that peer or a second opinion. We're seeing a lot of that in the appraisal world because some either come extremely low, some are extremely high. So what is an accurate number, right? And that's where that second opinion comes into play, and it could be very important and it could make a big difference. I have seen appraisals where there could be errors in it, or some of the values could be overstated sometimes.
Well, I was just going to ask you that really quick because I had one building where the appraisal said they had 5 elevators and they had 3. And for years, everybody had built off of that erroneous appraisal. So you've seen that too?
Absolutely. We're also seeing where maybe there's a separate garage structure, and that garage definitely does not have the same finishes as the residential tower, right? So we're seeing some appraisals use the same cost per square foot on both. That's not accurate, right? And so if we adjust the garage, that could certainly help the total overall valuation. We've also seen instances where the appraisals take the cost per square foot, or I'm sorry, the square footage of the balconies, but and they're just use that and multiply by the number of balconies. But we also have seen it where the size of the balconies could differ, right? There could be some smaller, some larger. So we cannot just arbitrarily use a number and use it for all of the balconies. So those things make an impact and could potentially lower that valuation, which of course, a lower valuation will translate into a lower premium. So definitely now we're starting to see a little bit of good news in terms of the insurance trends in the insurance market. There's companies that are coming back into the mix. But before we get into the market trends, Donna, the question that I hear the most is, can we self-insure? And I'm going to pass that on to you because that's such a big question. It's a great topic of discussion. And I know many folks that are on this webinar are interested in that, hearing that answer.
Yeah, I get that too. And I assume we're talking about windstorm. I hear that from clients, usually 50 units or smaller, okay? Because they'll call Pam and they'll say, everybody agrees. Everybody agrees we can't afford this. Can we self-insure? The statute only allows self-insurance in terms of SIFs, which are self-insurance funds. You have to combine with two other associations, and you have to be approved by the Office of Insurance Regulation, or OIR. There was years ago a Palm Beach SIF that tried, they never got approved. No one's ever done this. So when they talk about self-insurance, Pam, it's really meaning, can we just go without if we all take a vote? The hard answer is no, okay? If there's windstorm coverage out there in the market, you have to get it. If you tried to do this, a couple things would happen. One, you would expose yourselves as board members to significant potential personal liability, okay? And also what they're really saying is they're going to go bare. Because if you can't afford the premiums, you can't afford to replace the building if it knocks down, if it falls down. If you don't have sufficient liability coverage, I don't know how many condo owners know this, but each unit owner is liable potentially up to the fair market value of their units. By the way, that came into play with the Champlain Towers litigation. The survivors settled potentially for less because they knew that their liability could be up to the fair market value of their units. So this gets incredibly nuanced when you're talking about self-insurance. The answer is no. I would say you've got to look at your documents too, Pam, because part of the problem, part of the hole that these associations are in is that sometimes their documents are requiring them to pay for very expensive coverage when there's lower coverages available in the marketplace. But if they acquire the lower coverage, now they're potentially in breach of their governing documents. So once again, we're getting back to look at your documents.
Yeah, so another question I get a lot is, can we insure at a lower value, right? Our appraisal says the building value is $50 million. Can we insure at a lower value of, let's say, $20 million to keep the cost down, right?
Get an opinion.
Yeah.
Get a legal. I mean, I've had clients go out and get a report on it. What's the likelihood of a 250-year storm hitting? What would it cost? Again, is there any wiggle room in their documents to do that? Again, a legal opinion will tell you whether or not your attorney believes there's wiggle room under 718(111)(11) to do that.
Mm-hmm.
Now, also, the question could also be in terms of, do we fit the market to get full coverage? Because if we do, then that's the fiduciary responsibility of the board to go with what's available in the market. There's buildings that do not qualify for full limits because, as I mentioned before, some of the companies were just not comfortable insuring more than $5-10 million, or the premium difference would be, millions of dollars, which at that point, it doesn't make any sense. So if it's not available and the condo just cannot find it in the market, that's one answer, right? But if it is available, then that's a different story.
And if it is available, Pam, and they're not getting it, and people are trying to close on units, I'm sure you're seeing that at First Service as well.
Because many of these lenders, what happens is when somebody holds a mortgage, a lot of these banks, what they do is they sell their loans to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are the ones that are very strict with the insurance requirements, not just in terms of amount, but also in terms of deductible. Some agents in the past and even board members, everybody questions as well, why do I need to have a 5% deductible, right? Our value is so high, we're never going to have a loss that large. let's just go with a 10%, 15%. Well, guess what? That will be an issue with the lenders. They do not approve anything higher than a 5%. So definitely also something to keep in mind.
Right, for potential buyers, or yourselves, if you have mortgages,
For the
a lot of
association.
times they don't think about the impact that it has on lending requirements.
Again, we talked about financing for projects, right? If we need to secure a loan for the entire association, the entire condominium, that could be an issue because those banks are also going to require insurance.
Right, so if you can get 100% coverage, you should definitely get it. That's the responsible thing to do, regardless of the financial impact. It's bigger than just the impact on the budget, right? It has a lot bigger.
Well, I wanted to ask Pam about flood insurance, because the last two hurricanes we've seen, Helene and Milton, most of the damage has been flood. And a lot of these communities now are saying we're no longer in a flood zone. But Pam, is flood still reasonably affordable? For a while there, because it's nationally subsidized, it was
Yes.
pretty reasonable. Is it still?
Yeah, so it has actually gotten better ever since the new rating, which is called the rating 2.0. There's actually the premiums. Some associations saw significant reductions in premiums, very small amounts, so an increase because they actually weren't paying the correct amount. But this is a way that associations have been able to just look at this. And now remember, flood is regulated by FEMA. So even if you're dealing with a different insurance company, it's all regulated by FEMA, unless we're talking about an association that doesn't fit that program, or they're buying excess flood. At that time, you would have to go through the private flood market, and that could be a little bit more expensive. But in order to comply with most of the requirements, you would just need to purchase that limit that equals to the value, the flood value based on an appraisal, or $250,000 per unit. It's one of the two, right? The lesser amount. And so, yes, flood is a good topic. Now, flood does have a cap on increases. Even though we saw those past two hurricanes were mostly flood losses, FEMA could ultimately increase that cap. But right now it's at 18%. And once associations have reached their maximum amount, there's no more increases unless FEMA makes any additional changes. But that's also a great topic. Yes.
And
So I
think
feel like we
also
could have
lack
an
of,
entire webinar. I think we can do an entire webinar just on insurance, but for time's sake, we're going to move on. Sorry, Sean, did not mean to cut you
Go
off.
ahead.
Okay, what steps can boards take to ensure their properties are seen as best in class risks to attract more favorable insurance options? Pam.
Yes, that's the best thing, right? Because how can we position ourselves in the best light in front of the insurance companies? That's the most we can do, because the market is a market, the rates are the rates. The appraisal could be a big thing, right? Because, for example, I just spoke to a board member and he said, well, we just got an appraisal and it has a 17% increase. Of course, they need to budget for that 17% increase, because even if the rates stay the same, a 17% increase in values translates into 17% increase overall. So my first thought to him was, well, let's get a second opinion, right? Because how do we know that these values are not too high? So we did that. And now we realize we have another opinion where the values are coming in actually with a 15% reduction. So now we're only talking about a 2% increase, which is much better than a 17% increase. So being proactive, keeping track of everything that has been done in the property, to make it better. All the projects that we've been talking about, that helps, right? If we're in the process of replacing the roof, that's a major item that insurance companies are looking for. So
yeah, I was going to say, because we've experienced some properties that they're uninsurable to a certain extent, right? Because their roof is too old, or they have an engineering report that says you have all these, concrete restoration items that need to be addressed. And the property is in the process of undertaking all these repairs, but the insurers don't want to touch it until that work is either done or substantially completed before they feel more comfortable. And we have seen that those properties who were dropped by carriers and were forced into a disaster of an insurance situation with extremely high premiums and deductibles and low coverage limits, after the work is completed or substantially completed, the carriers are coming back. They're giving them full coverage, much more favorable premiums. Their budgets are going down. So make sure that you're being proactive in doing the work before it's a problem to mitigate that risk with the insurance.
Guys,
And
I
also-
want to ask you both, I'm sorry, I want to ask you both about hurricane protection, because the last legislative session, we saw a standalone bill about impact windows and shutters. So I'm a little surprised, given that we're talking about the insurance crisis in Florida, that more condo associations are not taking the vote to allow the boards to install hurricane protection as a common expense. Are you surprised about that? Because the statute does say that a majority of the members can approve the board hardening all the windows. And of course, in many of these communities, let's say 40, 50, 60%. If, by the way, if you have more than 50% of your units that are already hardened with impact glass, that's a no-brainer vote to take it, because the people who already have the impact glass will be credited towards that special assessment. So it's really only the people who don't have it are going to pay for the installation by the association of impact glass in their units. And Pam, doesn't that ameliorate the insurance rate?
Absolutely, that's a big discount, right? Because that's the first thing that insurance companies look at. How is your building protected? What is the age of the roof? And do we have impact glass or shutters? It has to be either one or the other, or both, or a combination, but it has to be 100% of the openings in the building that are protected. Yes, and Donna, that question comes up all the time, especially for older buildings that maybe have, like you said, a percentage of units that are protected, but the rest are not. So I have seen both sides of it, where some boards are making that decision to just take on the project as a whole. Some are saying we're giving everybody about a year to complete it on their own. But I do think it's typically faster when the board takes it on as a project as a whole, right? And everybody has to do it, and they don't have a choice.
And I don't see the downside. If people already have paid for, are not going to pay for it, and it's going to help with your premiums, and let's be honest, it's going to help in the event of a storm. I don't understand the reluctance to exercise a statutory right.
I think it's just the cost ultimately, but when they see the ultimate return and how much that is going to minimize that premium increase or lower those premiums, it is worth it, in my opinion. Absolutely.
So Donna, did new legislation this year help with the hardening costs, with some assistance that can be applied for toward that?
Yeah, there was a bill, Sean, that passed with the My Save Florida Condo Act. That, again, I think the pot is $30 million. It's a dollar for dollar reimbursement. So you're not just going to get the money, you're going to lay it out, and then you're going to be reimbursed. But again, it's such a small pot, and there's so many associations that are needing this. Everybody's kind of queuing up for this. As of right now, I don't think they've actually started releasing any money. I think they're still reviewing all of the applications that have come in for the program. But as we've just been talking, as Pam just mentioned as well, the impetus for it is, I think everybody acknowledges that where we live in such a geographically vulnerable state like Florida, we need to harden our buildings. So maybe we'll see, Sean, that program expanded in the next session.
Let's hope so.
Good discussion. So Donna, why don't we talk about some of the changes for the new board education requirements that came into effect in July? You want to touch on that?
Oh, that's fun. Okay, so now condo directors have to take a 4-hour board certification class, but it's every 8 years. Okay, a few people thought they had to do this every year. 4 hours every year would be a burden. It's 4 hours every 8 years. Now, for board members who were already sitting on their boards when the bill went into effect July 1st, they have until June 30th, 2025 to get those 4 hours in. The other big change is you need to take 1 hour of a legal update class every year thereafter in between, okay? So people who've been elected or appointed after July 1st, they have 90 days to get that class in and to give that certificate to the secretary of the association. By the way, this is not true for cooperative directors. So if we have any, I don't know why that is. Sometimes co-ops have been overlooked for better or for worse over the years, but that doesn't apply to them. But for our condo board members, and look, I know you guys put on all these programs. We do, the state does. I think it's a good thing. And the reason I think it's a good thing is because, and we're going to talk about it in a few minutes, there's potential personal liability for people sitting on these boards. We don't want good people leaving the boards, but that's where the education comes in, where we can help you kind of figure out what your role is and how to navigate it.
Very good point. Sean, anything to add that you're seeing at your properties?
I think being mindful of that 90-day deadline for newly elected or appointed board members after July 1st is very important to keep track of. Again, there are many providers who are offering these courses, from the law firms such as Becker. First Service offers a free 4-hour board certification course that covers both condo and HOAs. In case you're on the boards of both, right? You can kill 2 birds with 1 stone. And the state of Florida, the DBPR publishes a list of approved course providers that you can find online through their website as well, which I'm sure they update as more course providers get approved. And you know, it's an educated and informed board member is going to be a more successful board member in the end. So to Donna's point, it's not necessarily a bad thing. We understand it's a tedious thing, but in the end, you're going to be a better fiduciary for your community, being more educated.
So this is a very hot topic. With rising assessments becoming unaffordable, so for some owners, condo terminations are being considered by boards. Donna, can you explain why some condo associations are considering condo termination, and what does that look like?
So, I mean, listen, Joey, I have right now 6 clients that are evaluating offers from multiple developers. They're in wonderful geographic locations along the coast. They're older communities. I want to say off the bat, because I think we may have some co-op people listening, because some of the oldest housing stock, multifamily housing stock in Florida was what? Cooperatives. And some of these properties are 50, 60 years. Their process is a lot different. For a co-op, the statute, chapter 719 does not address it. It's a sale of the cooperative property, and there may be a double taxation issue for co-op owners. So get with counsel. It's a different from what I'm going to talk to you about right now. So in condominiums, chapter 718, specifically section 718.117 is your condo termination provision. The statute was changed in 2007 to talk about voluntary terminations. There are some involuntary terminations, like Pam, if they don't have enough insurance to rebuild, storm comes, knocks them down, 50% or more is gone, they're going to terminate because it's not habitable. They're not going to rebuild. But for optional, Joey, where they're just evaluating now, they're doing a cost benefit analysis. Does it make sense to keep going? You know, we've got a lot of people on fixed incomes. We know in 2026, we're fully funding these SERS reserves. Right now, if they're in good locations, not only may they be approached, but they may be seeking developers to come out and say, hey, we're open to your offers. In 2007, the law said 80% could approve a termination if not more than 10% objected. That is not the law right now. The law was further amended in 2017 to change that to 5%. But this gets really nuanced, where you need a discussion with association counsel, because there was a case in 2016 that talked about whether or not retroactivity applied, because both of these changes regarding optional terminations said this applies to all associations in existence at this time, right? It was meant to apply retroactively. However, there's case law out there about whether or not you have language in your documents called Kaufman language, which is based on a case Kaufman v. Scheer, and whether or not your association has a set of documents that is set in stone with the statute at the time you were created, or can you take advantage of subsequent changes to the statute? So this is where you need to reach out if you're being approached by developers, or you want to sell potentially get with association counsel to figure out what statute applies, what's your threshold. And then of course, I know, Sean, you're going to weigh in on the politics of this because communication is going to be key. I've been out to some of these meetings, and there are people that have lived there for decades and they love living there, and they should love living where they're at. And this is going to be a very tough thing for them, particularly if you've had a bulk buyer, because that's one thing. Sometimes the developer has been buying up blocks of units where you're on a path and it's going to be a foregone conclusion because at some point they're going to own 90% of that building or 95%. And you may be the 2% holdout. So there's politics involved here. There's human sensitivity involved here. And then there's legalities.
Yeah, we definitely have some properties that have been approached by developers who have targeted them because they can tell the associations in distress, both from the physical standpoint, right? They haven't kept up with the major restoration projects over the years and reserve funding and proper budgeting, so that the ones that are in financial and physical distress are the primary targets of these developers in the prime areas along the coast, especially that are ripe for redevelopment. So yeah, it's a very tough position to be in when you're faced with very expensive milestone inspection requirements that you have to meet. And there's no way around it. You gotta pass those certifications for structural and electrical updates to bring everything up to code and make sure that they pass those inspections. And certainly the insurance costs on top of that recently, and the new SERS funding and reserve requirements on top of that, rising labor costs, rising costs of materials. People are getting priced out of their homes. And it's unfortunate, but that's the reality of the environment that we're in at the moment. Some associations are trying to hang on and get through it. But within those communities, you still have those who can't afford to continue living there, and they're forced to sell to the developers or another, buyer. And so we're going to continue to see that, I expect, over the coming years.
Yeah.
And that's something that should be discussed within the community and certainly with legal counsel as far as options and cost benefit to see, everybody's going to have to make their own decisions on what makes the best sense for themselves and for their community.
Yeah. So Sean, you actually just kind of summed up. We've got just a couple minutes here before we close out. But so why don't we go around the horn real quick? We can start with you, Donna, and then Pam. So everything we've talked about today, the new legislative changes impacting Florida condo market, particularly the buildings over 30 years old. What's your closing thoughts? What do you want to leave people with?
Okay, closing thoughts. Get informed. Hire the right professionals to help you. If you've been engaging in very informal operations over the decades, I have to tell you the bad news. Those days are over, particularly with the heightened potential liability, personal liability for directors that's baked right into the statute. And please pass a reasonable budget. Reserves by their very nature are meant to be funded by the budget. Special assessments are for your projects. And as Sean has pointed out, once you do those projects, your reserves will come down because you've got more useful life remaining. You don't want to fall into the trap that developers fall into, which is they create artificially low budgets. And what happens when you go through transition? Everybody's like, oh my God, this budget doesn't even meet our needs. If you pass an artificially low budget because you think it's making you more marketable, I'm here to tell you what you're acquiring is long-term collection issues. Because you're going to get purchasers in who are looking just at the budget, and they don't know that there's a series of multi-million-dollar special assessments years down the road to fund projects. So please, that would be my recommendation. Hire a group of professionals. I don't know how anybody's self-managing right now. And frankly, I don't know how anybody doesn't have an attorney on speed dial. So those would be my recommendations.
Awesome. Thank you. Pam, any last thoughts real quick?
Or my last thoughts would be to be proactive, proactive, proactive. That's the best advice I can give everybody in terms of insurance, in terms of financing, everything, right? Talk to the experts. Make sure you're either working with, the insurance agents that have the bandwidth, the leverage, the expertise in the marketplace. This is the time to be creative, to come up with options that are going to help the association, to make sure everything is presented to the insurance companies to assist with those insurance renewals. Don't wait until the last minute. If we talked about appraisals, potentially getting second opinions, getting reports, updated mitigation reports, all of that, it takes time to get all of it, right? So work on everything early, start talking with your management company about it, with the professionals, same in terms of lending options. It takes time, right? To get the approval, to go through the underwriting process, to get the approval from the bank, to get the approval from the membership if that's required. All of that could take time. So definitely work with your attorneys, with your CPAs, with the professionals, so everybody can help in that process and make it easier and not complicated, because it can sound complicated and overwhelming, but that's why we're here for that, to make sure it's not as complicated as it may seem.
Awesome. Thank you, Pam. Mine is just real quick, is to going back to reviewing your reserve study, reviewing your documents. I can't tell you how many managed and self-managed communities we've partnered with where there are things that are left out of the reserve study. So don't just assume that things are in there because you're ultimately accountable to it. So I would encourage you to make sure you review that.
I just add also, my main takeaway for everybody is to have a plan. Right? Don't be short-sighted. You need to have a plan for the years that are coming ahead. Be mindful of deadlines. And when things are coming due, have a plan well in advance. You need to be at least 2 years in advance for planning for what's coming ahead, and over-communicate the plan, the ideas, the strategies, the options available with your members on a frequent basis, and not just in board meetings, because as we know, not everybody attends board meetings. And if they're not getting the information, they're going to be caught by surprise. So emails, newsletters, regular old-fashioned, put it in the mail, letters, frequent communication with your membership about what's going on, what the plan is, getting them, to be a part of the process, to get their buy-in, so that when the time comes to get the votes, spend the money, pass budgets, all these things, everybody's on the same page, and there are no surprises.
Great closing statements by everyone. Thank you all so very much for your time. And, just my final thoughts are, as board members, we do have the best intentions, but we don't know what we don't know. And without the right expert leadership, we are at a very high liability position. So protect your investment, invest in your community, but don't forget to protect your personal liabilities as well. To our attendees, thank you so much for joining us today. Solving the condo conundrum, new regulations, rising costs, and aging structures. We hope you found the information helpful, and that you always have, find ways to take what you've learned and put it to work in your community. I do apologize for not having had the time to address questions, but you will have someone from our team reach out to you to go through some of those questions and see how we can help. Thanks, everybody.
Thank you, everyone.